Hey everyone, welcome to The Explainer. So glad you're joining us. If you're the kind of person who likes to cut straight through the corporate noise and get right down to the nuts and bolts of how top companies are actually performing, well, you're in exactly the right place. Today is July 8th, 2026, and we're setting our sights on a top-down reveal of Zigup's absolutely massive full-year results. We're going to lift the hood, look at the gears turning behind the scenes, and figure out exactly what is driving these numbers. Okay, let's dive into this. Look, when a mobility and fleet management giant like Zigup drops their year-end report, the market pays attention. But we aren't just going to skim the surface-level press release today. Oh no. We're breaking down exactly how they pulled off this exceptional growth, piece by piece, looking at both their financial ledgers and what's actually happening on the ground with their physical operations. Let's start right off the bat with the absolute heavy hitter here. Zigup brought in a massive £1.636 billion in total underlying revenue for the 2026 financial year. I mean, wow, that represents a really solid 5.2% top-line growth compared to last year. It's a huge number for sure, and it absolutely proves that demand across their core markets is staying incredibly robust. But as you probably know, revenue is really only half the story when we're talking about true corporate health.
Because the truly surprising figure in this report, it isn't actually that massive revenue number. It's their steady-state cash generation, which hit a remarkable £96 million. That is a massive positive inflection for the business. To put that into perspective for a second, that is a £79 million jump from the previous year. What does this tell us? It tells us Zigup isn't just growing its top line, they're getting significantly better at turning their daily, everyday operations into cold, hard cash.
So here's how we're going to unpack all of this today. First, we'll look at the regional engines of growth. Second, operations and tech upgrades. Third, managing the balance sheet. And finally, looking ahead to savings. All right, let's jump right into part one, regional engines of growth, where we unpack the geographies. To really understand a billion-pound revenue stream, we've got to look under the hood and see where that momentum is actually coming from. And we've got a fascinating tale of two regions here. On one hand, we've got the UK and Ireland. This region gave them that steady, reliable momentum, bringing in £413 million in vehicle hire revenue. That's a 5.2% growth, mostly driven by solid contract wins and extensions. But then, look at Spain. Spain acted as the high-growth standout engine for the entire year, surging by 16.2% to hit £349 million. So you've got this perfect blend, right? The UK provides the steady anchor, while Spain delivers the rapid expansion.
Of course, those regional revenues don't just magically appear out of thin air. They're generated by real, physical assets on the ground, which brings us to a really critical physical metric, 139,400. That was Zigup's total fleet size at the end of the period. That's a 5.9% annual growth. So every single percentage point of that revenue growth we just talked about, it is directly tied to how well they are utilizing and managing these nearly 140,000 vehicles.
Moving right along to part two, operations and tech upgrades, or what I like to call the machinery of growth. Now, what's really interesting about this is that it's one thing to own nearly 140,000 vehicles, but it's an entirely different beast to actually manage them efficiently. To handle this massive fleet growth, Zigup poured heavy investments into a super advanced contact center platform. They're essentially putting a human face on what could otherwise be, frankly, some pretty dry technical jargon. They are hyper-focused on the customer journey here. They want to make absolutely sure that when clients need support for any of those vehicles, the digital and the human touchpoints are just completely seamless. So, Zigup's core operational strategy is all about bridging the physical and the digital worlds. On the physical side, you've got the rapid deployment of the fleet itself. On the digital side, you have their simplification program, which they call One Road. This program goes heavy on third-party API integrations. Now, what that actually means in plain English is they're plugging external software tools directly into their own systems so everything talks to each other automatically. They are literally rewiring the company so their internal data flows just as smoothly as their vans do out on the highway. But let's be totally clear, it is not all digital. Their physical footprint is growing right alongside the tech. Zigup actually managed to open 6 brand new physical facilities this year. And these aren't just empty garages sitting around, they're already being actively filled up. This is thanks to some highly specific infrastructure sector contracts, over 2,000 specialist vehicles, and a really solid pipeline of insurance contract wins. Basically, they're building the physical capacity precisely where the demand is burning hottest. Okay, let's get into the numbers in part 3, managing the balance sheet. Time to track the money. Growth and expansion are fantastic, sure, but as we all know, growth costs money. The good news for Zigup is that this strategy is paying off directly in their core operating profit, their underlying EBITDA. Because it's one thing to grow your revenue, it's another thing entirely to actually grow your profit. And this brilliantly illustrates the point. Underlying EBITDA jumped from £464.5 million in FY2025 to a massive £502.6 million in FY2026, an 8.2% jump. It proves unequivocally that all this top-line revenue and fleet expansion is translating directly into robust core profitability.
So what do these stability metrics mean for the bigger picture? Well, a few things. First, their net debt to EBITDA is sitting at 1.9 times. That is safely tucked within their strict target range of 1 to 2 times. Second, 77% of their debt is fixed. That is a crucial detail because it provides an incredible buffer against wild fluctuations in interest rates. And finally, even with all this going on, they still managed to raise their full-year dividend to 27 pence per share. So the takeaway here? They are growing aggressively, sure, but they're maintaining incredibly strict leverage discipline, and they're still finding a way to reward their shareholders.
Now, if you're out there wondering what the ultimate safety net is for Zigup's £999 million of net debt, we'll look no further than this metric right here. Their fleet net book value reached an astonishing £1.76 billion this year. What does that mean? It means the real, tangible value of the actual physical vehicles they own heavily outweighs their total debt. It's just a massive, highly liquid asset base that completely underpins the entire financial structure of the company. It's a huge safety cushion.
Finally, Part 4, looking ahead to savings and the roadmap to FY2028.
So, having locked down the balance sheet and delivered just exceptional growth for the current year, the management team is now pivoting to the future. They want to squeeze even more operational efficiency out of this massive machine. Zigup is definitely not resting on its laurels here. They're executing a highly disciplined simplification program. Step 1. Deep improvements in the supply chain and how they engage with suppliers. That directly tees up Step 2, which is a target of £10 million in cost savings by FY2027, and all of that culminates in Step 3, hitting a £20 million run rate in savings from FY2028 onward. And you know the most impressive part of all this? They've already achieved a third of their target savings to date. The discipline is quite literally already paying off.
Which brings us to a final, pretty provocative thought for you to weigh. Because they spent so much cash buying more cars to fuel this growth, their overall return on capital employed, or ROCE, actually saw a short-term dilution. It dipped by 1.4 percentage points down to 11.2%. However, when you adjust for normalizations, their underlying ROCE actually improved by 0.5 percentage point. So the big question remains, is sacrificing a fraction of your short-term headline efficiency worth it to secure the long-term capacity to completely dominate the market? Well, based on the cash flow and the profit margins we've explored today, Zigup clearly believes the answer is a resounding yes. Thank you so much for joining me for this explainer. Keep asking those hard questions, and I'll catch you next time.